monetary policy, and in particular central banks, have paid too much attention to changes in interest rates, how much you can change interest rates in order to affect prices and output, so the decisions made by investors, by businessmen, business people, or households, for example. This has been the consensus in the making of monetary policy before the outbreak of the global financial crisis. But we have disregarded, to a large extent, how much changes in the amount of money in the economy affect prices and output. Actually, one of the few things we know is a sort of a universal law in economics, is that over the long term, the amount of money in circulation does affect prices. Actually, the price level is mainly determined over the long term by the amount of money created in the economy by banks and by the central bank. This is very well stated and empirically tested by the so-called quantitative theory of money. So one of the things we should do is to restate a monetary analysis in order to make monetary policy decisions. This didn't happen, again, in the years prior to the global financial crisis, and it led to an excess in money growth before 2007 and 2008, and then to a too little rate of growth of money in the midst of the global financial crisis. Well, the ECB was established in 1999, and from 1999 to 2003, it mainly followed the very successful anti-inflationary policy developed decades before by the Bundesbank, the central bank in Germany. So essentially what the central bank did, what the European Central Bank did, was to adopt the so-called reference value for the broad money growth in the Eurozone, M3 as they call it. This served pretty well for the first few years of the running of the single monetary policy. It was a period of quite a stable economic growth and also quite stable prices, CPI prices in particular. From May 2003 up to the outbreak of the crisis, the summer of 2007, the European Central Bank made a major revision of its monetary policy strategy. In May 2003, what they did effectively, in my opinion, is to downgrade the information provided by the so-called first pillar of its monetary policy, which was monetary analysis. And since that, from that moment onwards, they didn't pay as much attention as they did to developments in monetary growth, in broad monetary growth in particular. And this had an impact in monetary figures and in prices, of course. You can tell there was an excess in money growth in the years prior to the global financial crisis, and an excess also in assets prices, assets inflation really, in stock prices and also in residential property prices in quite several countries, in many countries in Europe, but in particular, I would say the UK, Ireland and Spain for sure. There is another period we may want to make an analysis of, which is what happened once the crisis struck in the summer of 2007 and onwards. At that time, in the summer of 2007, when it was very obvious that there were severe problems in the banking market, in the liquidity provided by other banks to their competitors, the central bank, the European Central Bank did the right thing. The European Central Bank stepped in the market and provided extra liquidity. It acted very promptly and very decisively as what we call the lender of last resort of the banking sector. And it did it very well, much better than the US Federal Reserve or the Bank of England. But there were concerns about the inflation that these measures could create over the long term. And by 2010, 2011, there were pressures in the bank to withdraw these extraordinary lending measures. And these have had an impact on monetary growth in the Eurozone and led to a great extent to the so-called sovereign debt crisis. Essentially what it did is to aggravate the existing crisis. Finally, this was sorted somehow by the appointment of the new president of the ECB, Mario Draghi, who in 2012 and from 2012 onwards resumed those extraordinary lending programs and even QE. And you can tell this has produced a major impact in broad money growth figures in the Eurozone and has helped the European economy to recover in recent years. The main policy lesson is that we should aim at establishing and developing a monetary policy which is stable over the long term. By stable, I mean not too much money provided to the economy in the good years and not too little money in the bad years. So basically, let's resume monetary stability in order to achieve a sound and stable economic growth over the long term around the trend rate of growth of the economy that can be around 2% in major developed economies. This means resuming monetary analysis, broad money analysis, in order to anticipate changes in prices and output. So let's go back to the fundamentals in monetary economics. Let's analyze how changes in money growth affect prices and output along the cycle. Let's adopt a sort of a reference value for money growth in order to achieve monetary stability. So this is something we do in the paper we just published at the Institute of International Monetary Research, which is entitled "Have Central Banks Forgotten About Money?", which is applied in particular to the ECB, and it has been written by a colleague of mine, Professor Congdon, and myself.